What's up guys, welcome back to the new video. I'm your host Yash from Equitymaster, trying to make markets simpler for you. Sorry for missing out in the action for the past couple of weeks. Between non-stop events and travel, I didn't have time to record any videos. So before we get into today's topic, a quick heads up. Registration for Equitymaster's annual conference, which is held at the prestigious Taj Mahal Palace Hotel in Mumbai, are open. If you would like to spend a full day at the Taj in Mumbai in the company of like-minded investors and interact with a panel of prominent stock market geniuses in person, do check out the entire descriptions in the description below. Anyways, coming back to today's topic, today I want to talk about some high-quality microcap stocks and broadly touch the topic of business-like investing. You see, father of value investing Benjamin Graham would say, investment is most intelligent when it is the most business-like. You see, stocks are not mere pieces of paper. Rather, they represent underlying businesses, and you get to invest in stocks like you're buying a stake in the business. Broadly, there are two ways to do such businesses like investing. First, you buy a stake in the business to profit from the rise of its fair value over time. As the company increases the business, it does every year, its revenues go higher. As its revenues move higher, so does its profit. And as this process continues over the years, the value of the company too increases, as with greater profit making capacity comes with a greater market value. While the above process takes place over the long term, it is not always a smooth one-way street up. Which brings us to the second way in which one can go about business like investing. In the shorter term, stock prices see massive gyrations depending on how excited or disinterested the public gets about stocks. Due to this, stock prices sometimes go much above the underlying fair value of the company and at times much lower. As a result, it often becomes possible to buy a company when its stock becomes undervalued in the market and sell it when it reaches the fair value. In this case, you are trying to profit from the market's undervaluation of the business rather than a rise in its fair value on account of growth in revenue and profits. In this video, we are going to look at 5 such microcap stocks that fall under the latter category. These microcap companies are trading significantly lower compared to their original book value and their 5-year average historical valuations. Before we move on, please note that this video is for information purposes only. It's not a stock recommendation and should not be treated as such. There's no opinion or view on any stock covered herein. With that disclaimer out of the way, let's get started. First stock on this list is Muthoot Capital. Incorporated in 1994, Muthoot Capital is a deposit-taking, systematically important non-banking financial company. Initially, it provided gold loans, but subsequently, as the group scaled up its gold financing business in Muthoot Finance, Muthoot Capital entered the two-wheeler financing segment in financial year 1998 and gradually exited the gold loan business. During the pandemic, the company faced various challenges and it even posted a loss in financial year 2022. But since then, it's in a cleanup mode. The company sold its portfolio, which was affected due to the pandemic, worth rupees 2.4 billion to the ARC. The company is now on a growth trajectory with average monthly disbursements of rupees 1.2 billion during financial year 24 against rupees 1.1 billion in financial year 23 and rupees 960 million during financial year 22. The company's latest credit report also highlights the significant changes it has made in its collection mechanisms by enforcing strong follow-up right from softer delinquency buckets. Despite all this, the company's valuations are still reasonable. It is currently trading at a small discount to its book value. Muthoot Capital's 10-year median price to book value multiple stands at 1.5x. At the current price of rupees 350, Muthoot Capital trades at a price to book value multiple of 1x. In 2024, so far, shares of the company have fallen around 15%. Moving on to the second stock on our list, Deo Spinners manufactures and distributes synthetic and blended yarn. Its product portfolio includes polyester acrylic, viscose, polyester viscose blends, polyester acrylic blends, and among other things. The company is located in Chandigarh and is a well-established name in the textile industry. Under the leadership of its current chairman, the company has evolved into a leading manufacturer of dyed synthetic yarn. In recent quarters, the company's performance has slowed down due to an adverse demand-supply situation in the synthetic yarns industry. This has resulted in the company posting losses in 3 consecutive years. Nevertheless, it has strong growth prospects in place. Deepak Spinners is banking on demand outlook for MMF yarns to improve going forward as people opt for sportswear, performance wear, and athleisure. Since the company sells its products mainly through dealers and agents, it has established a good relationship with customers, which helps in getting repeat orders. At the current price of rupees 222, Deepak Spinners trades at a price to book value multiple of 0.67x, a 30% discount compared to its book value. It's also below the 5-year median price to book value of 0.75. In 2024 so far, Deepak Spinners share price has fallen around 14%. Moving on to the third microcap stock in this list, Capri Hans India is engaged in the business of manufacturing rigid and flexible PVC films, coated films, and plastic extruded products. It was incorporated as a privately held company in April 1946 and then was listed on the Bombay Stock Exchange in 1976. The company is among the prominent players in rigid packaging. It has two manufacturing facilities in Thane and Nasik. Capri Hans has been in the business of flexible PVC products since 1957. It has a well-established track record of around 6 decades in the packaging industry. The company's performance has been impacted in recent years. It has received a lot of backlashes for the acquisition of TPI unit from its holding company. After the acquisition, the company went from a zero-debt company to a highly leveraged one. The company took over the liabilities of Bill Care worth Rs 6.2 billion. This was done so that Capri Hans could meet its base film requirement from the acquired unit and not rely on imports. Nevertheless, the company is hopeful of turning a corner as the sectoral outlook improves. The company may also show improvement in the coming quarters owing to the backward integration kicking off and Capri Hans benefiting from the cost savings therein. Coming to its valuations, the stock is trading at a 60% discount to its actual book value. Compared to its 5-year average price to book value of 0.6, Capri Hans currently trades at a price to book value multiple of 0.4x. In 2024 so far, shares of the company have fallen around 24%. Moving on to the fourth stock on this list, based out of Gujarat, Kiri Industries is one of the largest manufacturers and exporters of a wide range of dyes, dye intermediates, and basic chemicals from India. The company is a certified key business partner with world's top dye stuff majors across Asia Pacific, the European Union, and the USA. It provides products and services across the whole value chain in numerous industrial sectors, including apparel, hosiery, automotive, carpets, leather, paper, home upholstery, industrial fabrics, among others. The company has a manufacturing facility at Baroda, Gujarat. After posting a loss in the last quarter of financial year 24, the company started financial year 25 on a good note by quickly turning around. It reported consolidated revenue of rupees 2.7 billion, a 17% year-on-year growth, while net profit came in at rupees 782 million, primarily due to its share of profit from Dystar amounting to rupees 805 million. A big overhang for Kiri has been the legal proceedings for its Dystar case. Recently, Singapore International Commercial Court ordered an en bloc sale of Dystar without a reserve price with a long stop date set for December 25. Kiri Industries is set to receive $604 million in priority from this sale proceeds. To diversify from core operations, Kiri Industries is exploring investment options in renewable energy sector. It's also looking to dip its toes in electric vehicle sectors and fertilizers, reflecting a strategic shift towards high growth. For all this, Kiri Industries has planned a massive capex of rupees 50 billion. Coming to its valuations, Kiri Industries at the current price of rupees 380 trades at a price to book value multiple of 0.7x, a discount of over 25% from its actual book value and below its 5-year average of 0.8x. In 2024 so far, shares of Kiri Industries have fallen 2%. The last stock on this list is RNCO Industries, part of the Chennai-based RNCO group. RNCO Industries is engaged in the manufacture of fiber cement sheets and calcium silicate boards. It is also engaged in the spinning of cotton yarn, sale of surplus electricity generated from its windmill, and computer software. In financial year 2023, the company's operating performance was impacted largely due to an increase in its raw material costs and global challenges. However, as input costs have started to come down, the company marked an improvement. The company's sales and profits have seen a decent growth in the past 3 quarters. As part of its diversification efforts, the company has entered the non-asbestos based roofing products, while it also has a good presence in the Sri Lankan market. The company recently postponed its capex plans to the latter half of financial year 25 owing to uncertain market conditions. Coming to its valuations, RNCO Industries trades at a price to book value multiple of 0.53x, a discount of almost 50% from its actual book value. The median price to book value multiple for RNCO in the past 5 years has remained in the range of 0.5x to 0.6x. In 2024 so far, shares of RNCO Industries have moved up by around 15%. So there you go. These were just a few examples of beaten down, fallen out of favor stocks that look undervalued right now on a price to book value basis. Before you go about investing in any stock, it is important to do your own research and understand the risk involved. No matter how great the prospects, you must always consider your risk bearing capacity and investment horizon. That's it for today. Thank you for tuning in every week, and to stay updated, don't forget to subscribe to our channel and like this video. See you in the next one. Happy investing.